Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2025 December 31st, and today's theme is simple. 2026 is going to price uncertainty like it pays rent.
Finally, a year-end episode. I love this part, where we all pretend we're calm, while our portfolios are doing interpretive dance.
3 stories, tight and practical. Fed minutes show a deep divide on rate cuts. Oil is headed for its deepest annual loss since 2020 on surplus concerns, and Nvidia is reportedly asking TSMC to ramp H200 production as China demand jumps.
Rates, crude, and chips. The holy trinity of why is everything expensive? Let's go.
Story 1. Fed minutes detail a deep divide on the timing of further rate cuts. The key point, officials are split on whether inflation staying elevated or unemployment rising is the bigger risk, so the path of cuts is not a straight line.
Half the committee is staring at prices like, stop it, and the other half is staring at jobs like, please don't do a recession.
Exactly. The simple finance version. The Fed is basically adjusting the thermostat in a house where one room is freezing and the other room is on fire. If they cut too soon, inflation can reaccelerate. If they wait too long, the labor market can crack.
And my mortgage is the house. Cool. So what should a normal person do, besides refreshing rate quotes like it's concert tickets?
Actionable angle. Treat 2026 as a range, not a point forecast. If you have variable rate debt, prioritize paying it down, because higher for longer is still on the table. If you're shopping mortgages, focus on total affordability and refi flexibility, not perfect timing.
So you're saying don't bet the house on the Fed, literally. Also, what about investing? Because my group chat thinks rate cuts are basically a buy button.
For portfolios, the Fed split raises 2 risks, duration risk in bonds and valuation risk in growth stocks. If cuts come later, long-duration assets can wobble. Practical move. Check your bond fund's duration and your equity concentration, especially if you're heavy in rate-sensitive names.
Duration risk sounds like a medical condition. Doctor, I've been exposed to too much long-dated treasury.
Story 2. Oil is headed for its steepest annual loss since 2020, with markets focused on surplus concerns in 2026. Even with geopolitics in the headlines, traders are looking at supply growth and demand uncertainty and saying, math wins.
Oil is the one thing that can have global tension, shipping risks, and headline chaos, and still be like, yeah, but we have too much of me.
Simple version, oil is like a supermarket product. If the backroom is stacked and more deliveries are coming, prices fall, even if customers are arguing in aisle 5. The market's watching OPEC meetings as a potential catalyst, but expectations lean toward oversupply pressure.
Okay, normal people impact. Do I finally get a break at the pump, or does my local gas station still do luxury pricing, like it's a handbag?
Lower crude generally helps gasoline and shipping costs, but it's not one-to-one. Taxes, refining capacity, and regional supply matter. For households, the bigger picture is inflation. Softer energy prices can reduce headline inflation pressure, which, ironically, can support the case for rate cuts later.
So oil falling can make the Fed feel less stressed. Love that. My car is basically doing monetary policy now.
Story 3. Reports say Nvidia is asking TSMC to ramp up H200 production as demand from Chinese tech companies jumps. The report cites orders for more than 2 million H200 chips for 2026 versus Nvidia holding around 700,000 units in stock, so supply is the bottleneck.
2 million chips? That's not a trend. That's a line item with a gym membership. Also, why is it always TSMC in the middle of every tech story like the final boss?
Because foundries are the production constraint. Simple analogy. Nvidia designs the recipe, but TSMC runs the kitchen. If the kitchen is booked, the whole restaurant sells fewer meals, no matter how good the menu is.
And the customers are like, I'll take 12 GPUs and a side of world peace. How does this hit regular investors, besides making every earnings call say AI 47 times?
3 takeaways. 1. Supply chain leverage. Foundries and advanced packaging can capture pricing power. 2. Capex cycle. More chip production implies more spending on equipment, power, and data centers. 3. Concentration risk. If your portfolio's gains depend on a narrow AI trade, you need a plan for volatility.
So diversify, but don't pretend you're above the AI trade. Got it. It's like saying you don't eat sugar while holding a donut.
Quick recap for 2025, December 31st. The Fed minutes show real disagreement, which means rate paths can surprise. Oil's slump says surplus fears can dominate headlines. And the Nvidia TSMC story says AI demand is real, but supply constraints and concentration risk are too.
Your homework: check your debt rates, check your bond duration, and check if your portfolio is basically one giant AI sticker. Also, hydrate. It's year-end.
Subscribe for daily finance clarity with minimal nonsense. Well, minimal by our standards. And comment one thing you're changing in 2026: spending, saving, investing, or career. We'll build episodes around real listener goals.
And if your 2026 plan is manifesting, please also add automating. Auto transfer beats vibes. See you next episode.